Hello, everyone, and welcome back to another episode of the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoen. On today's docket, we have some interesting developments to discuss, starting with inflation trends in Canada and their potential impact on interest rates. So let's dive right in. Canada's inflation rate continued its downward trajectory in July, with the headline Consumer Price Index, or CPI, slowing to 2.5%, according to Statistics Canada. This marks a decrease from June's 2.7% and is in line with market expectations. The Bank of Canada's preferred measure of core inflation also showed a downward trend. The CPI median came in at 2.4%, and the CPI trim was reported at 2.7%. These figures reflect a broader easing of inflationary pressures across various sectors. The deceleration in inflation is attributed to base year effects, where current price increases are compared to a period of high inflation from the previous year. Specifically, prices for travel tours decreased by 2.8% year over year, while passenger vehicle prices fell by 1.4%. Shelter costs, a significant component of the Consumer Price Index, experienced their slowest increase in 17 months, rising by 5.7% compared to 6.2% in June. This moderation in shelter costs was driven by a slowdown in rent inflation, which eased to 8.5% year over year from 8.8%, and a reduction in mortgage interest costs, which increased by 21% year over year, down from 22.3% in the previous month. The ongoing drop in inflation fits well with what the Bank of Canada has been predicting and boosts the chances of another rate cut. Many analysts expect the central bank to lower its key interest rate by 0.25% at its upcoming meeting on September 4th. Benjamin Reitzes from BMO noted, "The July Consumer Price Index report should further cement a 25 basis point rate cut from the Bank of Canada in September. There's no urgency for policymakers to act more aggressively at this point, but rate cuts will keep coming as inflation continues to move toward 2% and the economy sports a sizable output gap." Looking ahead, the August inflation data will be released on September 17, 2024. Analysts and economists will closely scrutinize this report for additional clues about the trajectory of inflation and the Bank of Canada's future monetary policy decisions. James Orlando from TD said that with inflation risks fading, the central bank's focus has shifted to addressing weakness in the rest of the economy. Given that the policy rate remains at restrictive levels, even after two rate cuts in June and July, there is plenty of room for the Bank of Canada to keep cutting over the rest of this year, he wrote. Ontario's housing minister is announcing a new set of planning rules, which he says will help more homes get built in communities across the province. Paul Calandra announced the new provincial planning statement today at the Association of Municipalities of Ontario conference, telling the municipal leaders in attendance that it will give them more tools and flexibility. He says the updated statement also streamlines the existing rules, coming in 100 pages and 30,000 words shorter. The planning statement guides municipal planners on their community's growth, including what areas will be used for housing, industry, and farming. Calandra says key changes encourage the building of more homes near major transit stations and on underused low-density lands such as shopping plazas and malls. The province has been consulting for several months on a new planning statement, and when upcoming changes were first announced at the same time as a housing bill, the group Environmental Defence said the two moves would promote low-density sprawl. A new Oxford economics report has stated that it will take 10 years for Canada's housing market to rebalance and make it more affordable for Canadians to buy their dream home. In a video brief following the release of the report, Tony Stillo, Director of Canada Economics at Oxford Economics, said another decade is required to build enough homes to restore affordability for housing across the country. To achieve this, Stillo said, 4.2 million new homes will need to be built between 2024 and 2035. This includes 2.9 million dwellings to satisfy growth in households, 700,000 new dwellings to make up for past shortfalls and ensure a normal vacancy rate, and around 600,000 new dwellings to remedy suppressed household formation due to unaffordability, he said. Stillo also said that an average of 300,000 housing units must be built yearly until 2035 to ensure that house prices in the country become more manageable for the average Canadian. This is historically high, but it's well within the nation's home building capacity, the economist said. Stillo added, "While it will take a long time to construct these new dwellings, we expect stronger growth in housing supply than in housing demand in the coming decade will mean house prices will rise more slowly than incomes." Stillo also said that housing affordability should improve progressively, with home ownership back within reach of the typical household by 2035. In 2022, Canada Mortgage and Housing Corporation, or CMHC, announced plans to expedite the construction of 3.5 million new homes. But that's not a realistic goal, according to Oxford Economics. Our analysis also finds that CMHC's aspirational target to build 3.5 million new houses by 2030, on top of those required for household formation, is not feasible and significantly overstates the actual number of new dwellings required to restore affordability, Stillo said. Construction capacity constraints, worker shortages, and other challenges make the requisite near tripling of the current pace of new home building almost impossible. Stillo also pointed out that the plan may result in housing oversupply, which will also cause other economic issues. It would result in approximately 1 in 5 dwellings being unoccupied, raising the risk of an oversupplied market and a prolonged slump in housing prices, especially as aging baby boomers begin selling or bestowing their homes in the mid-2030s, he said. Additionally, devoting too many resources to residential construction would likely crowd out business non-residential capital formation, hurting Canada's long-term economic potential and productivity growth. 2 interest rate cuts by the Bank of Canada have finally arrived, but home buyers are showing little sign of flocking back into the housing market just yet. National home sales retreated in July, according to the Canadian Real Estate Association, although time will tell whether the central bank's second cut, which arrived at the end of that month, will have a significant impact on convincing borrowers to step off the sidelines. Still, every little counts when it comes to interest rate cuts, according to Ottawa-based broker Chris Allard of Smart Debt Mortgages, who told Canadian Mortgage Professional that buyer prospects were already improving. Those falling rates have allowed some would-be buyers to set their sights on a more ambitious purchase than they might have envisaged during the past couple of years, according to Allard. If they could only qualify for a stacked condominium, maybe now they qualify for that super bottom-end townhouse, he said. Or if they were at the top end of a townhouse, maybe now they're inching into that lower-priced single. For a lot of people, it's making the difference. Conventional wisdom would dictate that buyers should hold fire on moving ahead with a home purchase now, especially with the prospect of further rate cuts on the horizon. Fixed rates have fallen precipitously in recent weeks, while dovish language by the Bank of Canada in its last policy rate announcement suggested the central bank is preparing to bring its own benchmark rate even lower before the end of the year. But Allard said purchasing now could offer buyers a way of avoiding the higher prices and greater competition that may emerge if rates continue to tick downwards. A lot of the conversation ends up becoming, is it better to buy now? Should we keep waiting for rates to continue going down? And I think for many, it's probably better to buy now because you're getting the better rates. But there's not a ton of people yet flooding the market, he said. A new Statistics Canada report has found that most Canadians have managed to keep up with their mortgage payments despite a sharp rise in interest rates. However, cracks are beginning to form in other areas of household debt. I think there's an interesting time slot here where it might make sense for certain potential buyers to buy, because if they continue to wait, yes, rates will go down. Yes, they might qualify for more, but maybe that house that they were going to buy for $700,000 is now $720,000. They're buying the same house, just paying more for it at a lower rate. It's really all the same thing, but they'll be doing that with more competition if they wait a little longer. In Allard's Ottawa market, certain property types are still seeing multiple offers, even though the temperature has cooled substantially since the days of record low rates and feverish competition of the COVID-19 pandemic. In general, though, the environment is much more favorable to buyers than it was then, a climate that might not last for much longer. For the most part, it means that people are able to bid without a multiple offer situation. It's a lot more comfortable to buy, he said. You can put a financing condition, do some adequate due diligence. It's much, much better for the buyer. When it comes to the fixed versus variable debate, meanwhile, Allard noted growing appetite for variable rates among borrowers who are comfortable with the risk factor, betting that rates will continue to fall and the spread between both options will narrow further. The two Bank of Canada cuts, though, have done little to change the general current preference of borrowers for shorter-term fixed rates. The primary reason for that is that a lot of people are tight from a cash flow standpoint, Allard said. And so, even though there's an opportunity for maybe variable costing less over time, they're saying, you know what? The reality is, I qualify for the house that I want to buy on a fixed rate, and my cash flow is just more comfortable today with a fixed rate, so I'm going to go that route. All right, folks, let's talk about the best mortgage rates in Ontario for August 2024. Forbes Advisor Canada has recently released a comprehensive guide that aims to equip you with essential insights and strategies to make informed mortgage decisions in this ever-evolving housing market. First up, let's go over some of the standout mortgage rates available this month. Nesto Inc. tops the list with some of the lowest rates Forbes Advisor has seen in this interest rate environment. For a 3-year fixed rate, Nesto offers 4.79%. while their 5-year fixed rate stands at an impressive 4.34%. If you're looking for a 10-year fixed rate, they have it at 6.09%. Dominion Lending Centers also offers competitive rates. Their 3-year variable rate is at 5.75%, and their 5-year fixed rate is at 4.79%. The Mortgage Center is another good option, matching Dominion Lending Centers with similar rates. For those interested in variable rates, Nesto Inc. also offers a 5-year variable rate at 5.40%, which is quite competitive. Meanwhile, Duca has a 3-year fixed rate at 6.34% and a 5-year fixed rate at 5.29%. While these rates are higher, Duca leverages its community focus to save residents money through great rates and swift approvals. The report also highlights that the Ontario housing market is experiencing a slowdown, with home sales 21.3% below the 5-year average. However, on a year-over-year basis, home sales are up 18.2%, and new listings have increased by 26.8%. This recent pricing shift has contributed to a more balanced market, providing potential buyers with more options. In its most recent rate announcement on July 24, 2024, the Bank of Canada cut its key interest rate by another 25 basis points to 4.50%. This is the second consecutive rate cut in over 4 years. The bank's governor, Tiff Macklem, mentioned that while inflation remains above the bank's 2% target, it has eased from 8.1% in June 2022 to 2.7% in June 2024. The latest Consumer Price Index update, released on August 20, 2024, showed that Canada's inflation rate came in as expected at 2.5% in July. This is lower than the 2.7% recorded in June. The broad-based deceleration year-over-year was driven largely by lower prices for travel tours, passenger vehicles, and electricity. So, what are the average mortgage rates in Ontario right now? As of August 9, 2024, the average rates are as follows. For a 3-year variable, it's 6.28%. For a 3-year fixed, it's 5.78%. For a 5-year variable, it's 6.49%. And for a 5-year fixed, it's 5.15%. Remember, these rates can change, so it's crucial to shop around and consult a mortgage broker to get the best rate possible for your specific situation. Boosting your creditworthiness is also key to securing a favorable mortgage rate. Timely payments and responsible credit management can significantly impact the rates you are offered. That wraps up today's episode. Thank you for tuning in to the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoen. Stay informed, stay prepared, and until next time, take care.